Okay, BA220. This is Paul, and I wanted to walk you through easy numbers specifically for this project because I know it's a bit confusing, and I want to give you a custom video for our project due on December 4th. So I've met with some of the teams already, but I'm going to go through here and show you all the things that you need to do. First, and I think I'll put this in the email too, some of the main criteria, but you need to have, let's say, 5 million in revenue by year 3. You need to have positive investor returns, and by that I mean a 30% IRR and a positive net present value. There needs to be some investment, and it will need to be reasonable terms for the investor. Let's say an investment of at least $500,000 and getting enough of the company for it to make sense for them. And of course, you cannot run out of cash, and I will show that to you. So let's get started here. Oh, by the way, so I'm at Upload, this VR place in Marina del Rey, and there's people walking all around. So if I get a little distracted, that's why. So let's just jump right in. First, this button is a little bit off on my screen, so don't worry about that. We're going to make it 3 years. And I've done this for most of the teams, if not all the teams that I've met with already. Okay, we're just going to focus on 3 years. So we'll say it's Acme Corporation. We're a C Corp, deduct taxes, yes, in California. And now all the taxes will be deducted automatically. Start month of January 2018. And here on the startup sheet, let me make a note here. The yellow tabs here are the input sheets. This is where you make entries. The blue tabs are the results sheets. You don't have to do anything here at all. So the P&L, cash flow, and balance sheet will all be done for you automatically. I'm going to make a sample entry here. Let's say computers for $5,000 in month 1, which corresponds to January 2018. As you can see here, computers are depreciated for 5 years. Now what happens every time we make an entry, you can look up here in the dashboard and you can see the amounts here. Remember, this is a capital expenditure. So on the P&L, on this mini P&L, we're only going to see depreciation, not the actual cost of the item. If we click on the P&L, it's now updating and we'll see the depreciation each year. Cash flow, we see the depreciation and amortization being added back and the complete cost of the item. And on the balance sheet, we see our computer minus accumulated depreciation. So again, you don't have to touch the P&L, cash flow, and balance sheet. And it's the same thing with an intangible asset. Let's say we get a software license for $25,000 in month 3, and we amortize that over 15 years. If we look on the P&L, we'll now see amortization here. On the cash flow, we see amortization and depreciation. And on the balance sheet, we now see the intangible asset. Okay, so that's how you do capital expenditures, which are your capital budgeting in one essence, and that's tangible and intangible assets on the startup sheet. Now we have expenses, and these are sales and marketing and operating expenses, just like we walked through in class. We can do advertising for $250 a month. It can increase 3% per year, and these are recurring monthly amounts. So any amount that we enter here will go on every month. But let's say in January we have a trade show for $5,000. These are one-time expenses that will add to that. All these titles here you can change, and you don't have to use all of them. For this assignment, let's say you need at least 3 sales and marketing expenses and at least 10 operating expenses, rent, communications, etc. Let's say for insurance, we're going to pay $200 a month, and that'll increase 5% per year. Now let's check on the P&L, and we'll see that sales and marketing expands to show advertising and insurance. So again, we're not doing anything on the P&L. Personnel, we've got consultants. So let's say we have a consultant for $1,000 a month, starting in month 1, and we'll say month 36. And we also have salaried employees. We're going to make the taxes 22%. Benefits are 5%, and annual increase 5%. CEO pulling down, cool, $100,000. Hey, you deserve it. Okay? Now we can look on a little handy dandy chart here, and we can see the salaries, payroll expenses, which are the taxes the employer pays, remember, in addition to the salary, and consultants. And those will also be on the P&L in operating expenses. Capiche? Okay, cool. Now we get to sales. And this is the heart of any business. But first, let's look up on our dashboard here. So we've got our expenses, taxes, and depreciation and amortization. And over here, we have leased cash. This cannot be negative. Leased cash is the lowest amount of cash in any month in the 36 months for the 3 years. So this means we're running out of money, we'll go bankrupt. We haven't done sales yet, of course, and we haven't done debt and investment. But when you're done and when you present this number has to be positive or you go bankrupt. Okay, so if we're going to sell a product, we can say that we'll sell it for $10. It costs us $2. We'll have 5% bad debt and returns, no commissions or royalties. You don't worry about sales tax. Days receivable, that means it takes us 30 days to get paid. Days payable, we can pay our factory 30 days after being billed. We'll hold our inventory for 30 days. So these are the basic product specs for a product. Now we'll start selling it in month 1, which is January, and you can just say for the purposes of this assignment that you have already been working on this for a while. We'll sell 1,000 in month 1. We're going to increase our sales monthly by 5%. Now, if we scroll down, we can see our percentage increase in unit volume, revenue per month, and cost of goods. And we can customize all these if we want to add seasonality and things like that. But if we go up here, now we see we have sales. And if we go to the P&L, we now have our sales and bad debt built in. So we already have a business. And we turn profitable in year 2 and 3. And here's a note about startups. You don't have to be profitable in year 1, maybe even year 2, maybe even year 3. Remember, profit is not cash. Okay, so that's how you do a product. And again, we added this, the unit price of what we sell it for, the unit cost is what we pay. That's how the program works. Now I'm going to take these out and show you how to do recurring revenue, which a lot of you are doing. So now we don't have any sales. So let's say you're doing a recurring revenue, a subscription program. So we'll start in month 1, which again is January. We'll sell 100 in the first month. And this is going to be a monthly program. And they'll last for 24 months, which means that anybody who starts in month 1, this is the new customers, the total that start that month, and the ones that drop. This is also called churn. You'll see that 24 months later, we have this first 100 leave. If we made this 6 months, you'll see that they start dropping off after 6 months. So we'll leave that at 6 months for now. Let's make it 12 months. Now you can either grow by percent every month or a flat number. Here let's grow by 20, which means every month. So the first month we get 100 new customers. After that we get 20 more each month. So 120, 140, etc. And you can see them dropping off here. Now, it's monthly, and we'll say that they pay $9 per month, both in their first month and after that. To get them, we're going to assume it costs us $5 and $1 per month just on various fees to keep them on board. Now we can see the summary of all of our revenue and costs for our subscription revenue model. If we go back to the top of sales, now we can see we've got some real revenue. Now we're not up to the 5 million in year 3 that we want, and our cash balance is still negative, but we've just started. This is a real big process of iteration, going back and forth, tweaking things, reducing expenses, increasing sales, etc. And we really haven't built out many expenses at all. We only put in one sales and marketing expense and one operating expense. But this is basically how you can fill it out. And this is the recurring revenue. Now, let's look at loans. I want to show you how easy it is to do, but you're probably not going to get a loan in reality for a startup unless you do a personal guarantee. If we wanted to do a loan for $500,000 at 5% interest, 180 months, starting in month one, that's all we have to do. It calculates all of our payments, our interest and principal, etc. So if we look on the P&L, now we can see that we have interest expense. Okay. We also have income taxes. That's figured in automatically, both federal and state taxes. So here's our interest expense. If we look on cash flow, we can see our decrease in long-term debt. So it's not exactly $500,000 in year one because we made some payments. And then these are the payments that we keep making. And on the balance sheet, we show the amount of the loan outstanding each year. But we're likely not going to get a loan, so we're going to blank that out, and we go back to negative cash amount. So let's go to investment. There's a fair amount of things going on here that I want to walk you through. I'm making it easy for you by saying that we can sell the company in year 3. When I say I'm making it easy for you, that's because you need to have a positive investor return. And the easiest way to get a positive investor return is assume that you sell the company at some point, because the investor then gets a pro rata amount of that sale. So if the investor owns 50% of the company, you sell the company in year 3 for $5 million, then the investor gets $2.5 million. So that's going to make your life easier. We're not going to worry about the valuation multiples, etc. What we're going to use is a standard rule of thumb that when you're an ongoing company, your valuation or the value of your company is the amount of sales you had in the last 12 months. That's a very simple rule of thumb that can change in many different circumstances, but that's what we use right now. So in this case right now, before we got up to 5 million, we can see that we have 874,000. And that is our value in year 3. So if we get an investment in year 1 of $500,000, in month 1 of $500,000, you can ignore the number of shares for now, and they own 50% of the company. Right away, you can see the return, which is also how much money they get back. Net present value is negative. ROI is negative. IRR is negative. So this is not a good investment for the investor. Of course, we haven't done much of the tweaking that we need to do. We need to have IRR of 30% and a positive net present value. So there's a lot of things you can do. You can say, well, we'll increase, and it has to be reasonable, and you have to present a good case for this. But let's say we increase by 50 new clients per month. Now let's go to the investor sheet, which shows in more detail. And now we see they put in 500,000 as an investment. 3 years later, they get back almost double the money. And we're getting there. That's almost the IRR that we need and a positive net present value. So that's getting close, and we have extra cash. Now, if you have extra cash, that means you don't need that much investment, but we're still not at the point where we have 5 million revenue. So you need to increase things. You can add more products, or you can have a higher ramp or faster ramp where you add clients more quickly, but then you'd have to show some marketing to go along with it. You can't just magically increase the number of customers without having a plan as to how you're going to get them. Now, if we have time, I'm happy to walk you through customer acquisition cost, customer lifetime value, etc. What else do I want to show you? Okay, so, and you can go back to the P&L, cash flow and balance sheet. The assumptions tab shows all the key assumptions that you have, which is a very handy thing to have. Analysis has a lot of financial ratios. Remember those things that we glossed over, I think, in class 3? Well, here they are. And you can see that people actually do use them. Break even shows it takes us to about month 11 to break even. And break even is used in different ways, or people have different definitions for it, but the really, sorry about that, the real accurate way is to think of it as accumulated net income. So when all of your net income added up for all time is positive, that's when you break even. Now we've looked at the investor sheet, which is where you really want to hone in on to see how things are going for the investors. Then for your assignment, there's a 2-page plan. And I'm going to send you the 1-page plan template, which is just basically a Microsoft Word document. The other page of the 2-page plan is generated for you automatically on the Reports tab here. So you can see it. Remember, our company name was Acme. Here it's prepared. It shows a mini P&L, cash flow, balance sheet, valuation, investment, and some charts. Let me just make this smaller here. And you can see this. And this is already formatted for you. And there are instructions here on how to put it in different programs. Okay? So I think that's about it. I think I'll go over some of the broad strokes with you again in an email to accompany this. But I want to keep this video short. There's more things to the program that you can explore. And I encourage you to do that. Like I said, this program has raised $1 billion. So if you want to do a startup, this program can be very helpful for you. And work with your teams and make the best business you can. You never know when you'll sort of trip across something that you'll find really interesting that will ignite your passion. So again, 5 million in year 3. No, the lease cash is positive. Investment of $500,000 or more. IRR of 30%. Net present value positive. And with enough expenses and personnel to really make it seem like a legitimate business. And then to do the 2-page plan for next week and the overall presentation the week after that. Now, for the real estate team, I'll talk with you, but basically what you would do here is look at each of the units. Let's say you have cheap, mid, and high price units in the apartment building. Okay? And the rent, think of unit price as rent. So the cheap would be, I don't know, $1,000. I don't know how big the units are. $1,500 and $2,000. There really is no unit cost here. There's operating expenses, utilities, and all that. And so cheap, let's say we have 10 units. We have 15 units of mid price and 20 units. Sorry, this is the start month. Okay? And we'd have 10, 15, 20. We're not going to increase because we're not going to make more apartments as we go along. But you can see our revenue already here. And I don't know for the real estate project what the numbers are, but we want to make them realistic, so we don't need to worry about the 5 million in year 3 guideline for this. Okay, so I'm sure you'll have more questions, but I wanted to do this quick video to walk you through the basic beats of the program and to make you feel more comfortable. All right, guys, take care and have a happy Thanksgiving.